Hello everyone, hope things are going great with you. Today we would be doing the part on automatic cancellation, which involves probably a late delivery or a late extension or a late cancellation, which is as per a specific rule of FEDI, Foreign Exchange Dealers Association of India, as per FEDI Rule 8. Now this is there in your new course study material from page 9.32 up to page 9.35. Some of the most complex pages that you would have seen, and this is also there, I guess, in your old syllabus. Problems are there even in your practice manual, in the old course practice manual. So we would be doing one problem from the new syllabus study material and one problem which is from the old course practice manual, so that you get a fair bit of practice over here. It's one of the most tricky concepts, and it generally involves some level of complexity. So before we proceed, what are we talking about? Let us say usually you are an importer and you have approached a bank for a forward contract. So as an importer, you would enter into a forward buy contract. The banker would sell the dollars to you and you would buy, which you can use to pay your supplier. Now, what does happen is, let us say you might have entered into such a contract on 1st of let us say April, which expires, let us say, on 1st of July. Now, ideally, you should come and take the delivery on 1st of July, and if not, the contract from what you have studied till now will by default be cancelled. Now, like you might have studied in your foundation or your 11th and 12th, that bills of exchange, there's usually a grace period of 3 days. In a similar way, FEDI gives the customer and the bank a 15-day grace period. So it says that on the date of maturity, ideally the cancellation should happen, will happen. However, if the contract remains overdue without any instruction from the customer, if it remains overdue on the due date, the customer, there is no show. The customer does not give the bank even any instructions. In which case, the bank is supposed to keep the contract open for another 15 days. The bank is supposed to keep the contract open for a maximum of 15 days. And if there is no instruction even up to the 15th day, then there will be automatic cancellation for the contract. Now, let us say the customer comes to you in the next 5 days, 6 days, 7 days, 8 days, 9 days, 10, 11, up to 15 days, the bank will entertain the customer and honor the contract subject to cancellation charges that you are going to study as per Rule 8. After the 15th day, the customer will still be obliged to pay the cancellation charges, but after the 15th day, even if the customer comes and says, okay, on the 20th day, give me the dollars, I'm ready to pay the charges, the banker will recover the charges, but legally, he has an enforceable right to recover the charges, but he's under no obligation to honor the contract. And as a result, as per FEDI rules, for 15 days, the contract remains open. Now, there is a no-show, and hence the banker is under an undue stress. Its assets liability management goes in for a toss, and hence FEDI rules require certain charges to be payable on cancellation, which are in 3 forms. This is as per FEDI rules. First is you have to calculate the exchange difference. What is the exchange difference? Exchange difference is the cancellation. So let us say the customer does not come on the date of maturity, but let us say, so the date of maturity is, let us say, 1st of July. The customer does not come to you on 1st of July. However, he comes to you on 10th of July. Acha, is that within the 15-day period? Yes. If not, then on the 15th day, there will be cancellation. But the customer comes to you on 15th of July. The banker would say that, well, you know what, you have actually come at a later date, and hence we will honor and give you the dollars that you need. You will not be left in the lurch, but we will treat this contract as if it was cancelled. And hence, on the actual date of cancellation, you will see what is the rate prevailing and you will compare it with your agreed forward rate. This is slightly different from all the sums that you have done. In general, the cancellation does happen before the date or on the date. Acha, if it is before the date, then you take the offsetting forward rate for the balance unexpired period and compare it with the agreed forward rate. Or if it is on the date of maturity, then you take the spot rate because you are on the date of maturity and compare it with the forward rate to find the gain or loss on cancellation. Here, on the date of maturity, that is 1st of July, let us say, there was no instruction, and as per FEDI rules, a contract would remain open for the next 15 days. Let us say the customer comes to you on the 10th day, let us say on 10th of July, and he requests. So the banker will first say that your original contract, we will give you the dollars under the new rates, but your original contract stands cancelled. And the gain or loss on cancellation will be the rate prevailing on the date the customer approached the bank. That is what you call as the spot rate on the date of actual cancellation. So this, as you can see, is the spot rate. It is a difference. The exchange is a spot rate on the date of actual cancellation, not the date of original maturity, that is 1st of July, on the actual cancellation, because that is when the actual cancellation happens. What if the customer does not come at all? Then the spot rate prevailing on the 15th day from the date of actual maturity. And you will compare it with the actual forward rate. This is the agreed forward rate with the customer. This is normal. This is what you actually do even in usual cancellation cases. Now, in certain questions, in both the questions rather, which is there in the new course study material as well as the old course PM, in both the questions, sometimes an exchange margin is given. These are like additional costs which are levied by the bank, and exchange margin is typically applied on the rate which is the cancellation rate which you take. So we have written after the exchange margin. This is important because at various other places this is not taken. Okay, this will give you the exchange difference. So is that it? Usually, yes. Usually, if you are doing a cancellation, that is it. There is nothing more. However, over here, the banker, apart from cancelling your contract, has also additional headaches, additional actions that it has to undertake because you did not give instructions and you did not show up on time. So what are the other additional actions that the banker will have to undergo? First of all, see, in the usual question, if it is cancellation on the due date, this is the only item. This is the only item that you take, and that too based on the rate as on the date of maturity. Here, it is after that, so you take that respective rate. Apart from this, the banker will have to enter into an additional action of swapping. What do you mean by swapping? Remember, banks operate on an asset liability management model. And generally what does happen is, if the bank has to honor the contract when you come walking, the bank has to keep it open for the next 15 days, and hence the bank would still not take the chance. The bank would say, generally when it would have entered into the original forward contract with you, it would have entered into another offsetting contract in the interbank market with another banks. Like there's a trader who will buy the goods and then he will sell you the goods. So if you have a contract to sell the goods, I would have agreed into a contract to buy those goods from somewhere. So the banker would have entered into such a contract, but that contract will expire on 1st of July. Now you might come walking in the next 15 days. Now the banker does not know that what will be the rates prevailing then, and hence the banker would generally have to enter into a new forward contract, which is generally, as per the FEDI rules, he would enter into the forward contract which is the nearest. 15 days is not even a month's time, so it is generally the contract which is nearest. Forward contract which is maturing the nearest from the date of your maturity. So maybe the July contract you will take the new forward contract. So if you are an importer, the bank has to ensure that when you come back, if you come back, then the bank has to give you the dollars, and hence it will enter into a forward buy contract. However, the bank would have already entered into a contract on, let us say, 1st of January, when you entered into a 3-month forward contract expiring on on 1st of April, when you entered into a 3-month contract expiring on 1st of July, the bank would have said, I have to pay him $1 lakh, but I have to receive that $1 lakh from someone else. And hence in the interbank market, I would have entered into a contract to receive that $1 lakh, which I would use to pay to the customer who is the importer. Now the importer does not show up, but bank has its own credit, goodwill, etc. Bank cannot now not show up for the, otherwise in the interbank market, no one will deal with that bank in the future. They will treat the bank as kind of a defaulting bank, and no one would then enter into such contracts with the bank in question, and hence the banker will have to honor that. And I am just discussing theory now because we are going to do 2 problems. I'll discuss it with numbers over there. So the banker would have entered into a contract with some other bank in the interbank market, which is going to fall due on 1st of July. Now the banker will not do a no-show, and the banker will receive those dollars. Let us say I have to hand those dollars out to the importer. The banker will receive those dollars at the agreed rate in the interbank market. What am I going to do with the dollars now? Well, I will sell those dollars in the spot market. And hence, due to the customer not showing up, had the customer showed up, the banker would have received these dollars and given those dollars to the customers, and hence nothing else would have been done. Here I'll have to receive it from the interbank market, but I can't give it to the customer because the customer has not shown up, not given any instructions, and hence I will have to sell that, for example, in the spot market. So that is one part of the swap. I'll have to sell that in the spot market, and at the same time, because the customer might come up in the future in the next 15 days, I will also have to enter into a new forward contract. So this is what you call as swapping. This can be different from an exporter, different from an importer, but this is also something that the banker has to do because you did not show up in time, and as a result, you will have to compensate the banker for any loss that he incurs even due to this swapping. And as we have seen over here, it is the difference of the spot rate on the original maturity date, in our example 1st of July, and the offsetting forward rate for the earliest maturity that you will take for the next 15 days, for example. This is also what a customer has to compensate. Now what happens is, and we will understand this better with the problem, we are just discussing theory over here. Once we do illustration number 9, which is there in your study material, you should be in a better position to understand this, and then do one practice problem where you should be even more clear. So what happens is there are cash flows. Remember, taking a forward contract, cancelling it, this is on paper. However, the bank on the date of maturity might have to incur certain actual cash flows. That is, the money that it is going to receive, let us say those $1,000 from the interbank market, against which it will have to write a check and pay rupees. That is an actual movement of cash. And those dollars that I will receive, I will sell it in the spot market and I will receive actually rupees. So there is an actual movement of cash that is happening, and sometimes it might happen that the banker might have to incur a higher or a lower cash movement, and hence the banker would say that, for example, if the customer is coming to me on 20th, on 10th of July instead of 1st of July, he is coming to me 10 days later, and if due to the customer coming 10 days later, if I have to incur certain extra cash flow, time value will also get attracted, and hence certain amount of interest will also be paid on the cash movement. So over here, difference of the spot rate on the date of actual maturity. Why? Because the money that you would have received from the interbank market, you will sell it in the spot market, and original forward rate in the interbank market. In the interbank market, not the agreed forward rate. The interbank rate that you would have taken for the purpose of asset liability management, into the contract size, into the interest rate, usually on outlay of funds, into the period of 10 days, for example, out of 365 days, would be the interest. And the total of these three, we will do it in problems and understand it better, will give you the cancellation charges. These are the total cancellation charges as per Rule 8 of FEDI. So what we have done is, in the next slide, we have just briefly written what is there in Rule 8 of FEDI. First, as we discussed, if there is no instruction from the customer, then the contract remains open for the next 15 days, after which it will get automatically cancelled. Second is an important point, as a penalization measure so that customers don't do such actions and are not negligent. FEDI has said that if there is any loss that is suffered by the banker, it has a legal right to recover that loss from the customer. However, if there is a gain, that gain need not be paid. Now, this is not usually the case. In case of normal cancellation questions, if the banker earns a gain, that is passed on to the customer, but not in case of these lax customers who don't even inform anything to the bank and keep the bank open to certain stress levels. And hence, FEDI, as a penalization measure, says that we will charge the loss from you, but we will not pass on any gain to you. We are not under any obligation as a penalty, as a penal measure. A lot of questions have exchange margins. You have to be very careful while adding or subtracting exchange margins. Usually, if it is for the customer a selling rate, exchange margin is going to be deducted. If it is for the customer, and I'm speaking for the customer, not for the banker, from the customer, the buying rate, that will increase the cost, and hence margins will be added. To which rates will they be added? Will they be added to all the rates? No, only those rates which are a direct outcome of this exercise. So the agreed forward rate was agreed irrespective. The interbank rate was agreed irrespective. The spot rate at which you are going to sell in the market is a spot rate in the normal market, irrespective. However, if I have to extend the contract, or if I have to cancel the contract on the date, so what I've written in green over here, on that exchange margin will apply, and on the extension rate the exchange margin will apply. So what I will do is I will solve illustration number 9 of the ICI study material, which is there on page 9.33, and then probably do another problem from the old course practice manual. Okay, so let's go to illustration number 9. I hope this study material is there in front of you. We'll solve it at length. An importer booked a forward contract. when I solve everything from the perspective of the customer and then see at the end what will be done for the banker. You can solve in another way as well. I will analyze every rate from the perspective of the customer, who is the importer. An importer booked a forward contract with his bank on 10th of April for USD 2 lakhs due on 10th of June. So this seems to be a 2-month contract, May and June. Yes, at the rate rupees 64.40. The bank covered its position in the interbank market or in the market at 64.28. So what would have happened is, just for your knowledge, on 1st of April, on 10th of April, there is no cash flow. There are just 2 pieces of papers that have been signed by the bank, and I'm evaluating this from the perspective of the customer actually. So there is a importer. The importer needs dollars and he needs dollars on 10th of June. So he's worried. So what he has done is he would have entered into a forward purchase. From the perspective of the customer, it's a forward purchase. From the perspective of a bank, it's a forward sale. So there would be a forward purchase contract that would have been entered, which would actually mature on 10th of June, and this would be at the rate rupees 64.40 per dollar. 64.40. This is what we call as the agreed forward rate. 64.40 per dollar. This is what is called as the agreed. When we have written in the notes agreed forward rate, this is what we mean by the agreed forward rate. But in order to banker is in the business of making profits, and hence in order to manage that risk and earn profits, the banker itself would have also entered into a forward contract. This is a forward purchase entered by the bank in question, which will also mature on 10th of June. So on 10th of June, banker will receive how many dollars? I think this is $2 lakh. He will receive $2 lakh from the interbank market, maybe from some other bank. Like a retailer sells to the final consumers, but a retailer purchases goods from the wholesaler. So like the wholesale market. So the interbank market, usually at a cheaper price. So this is rupees 64.28 if I'm not wrong to the dollar. And this will, if everything goes as planned, the banker is sitting on a profit of 0.12 for every dollar transaction. So this is the forward rate in the interbank market. This is the forward rate in the interbank market. Okay, so this is the transaction that has happened on 10th of April. The exchange rates for dollar in the interbank market on 10th and 20th June. This is 10th June is the date of maturity. So just for our understanding, 10th of June is the date of original maturity. When we write down in our notes, 10th of June refers to the original maturity date when the contract was supposed to mature. And let us say, what is 20th June? We don't really know as such. It is within that 15-day period. Generally, the contract would remain alive till around 25th of June, but this is 20th June, somewhere in the middle. You have been given various rates. On the next page, an exchange margin of 0.1% and an interest on outlay of funds of 12% is there. Importer requests on 20th of June for an extension of the contract. 20th June. So on 20th June, extension is requested, which means customer has come to your doorstep on 20th of June. So if extension is requested, there is an implied cancellation. There is an implied cancellation on 10th of June, on 20th of June. वैसे तो 10th June पे होना चाहिए था. Had there been no FedI Rule 8, we would have cancelled directly on 10th of June. However, that 15-day period will continue till 25th of June, and 20th of June is within that. So there is an implied cancellation that is happening on 20th of June. Fair. Okay. So this is the date of actual cancellation. So that is 20th June is the date of actual cancellation. That is actual cancellation. Date is 20th of June. Okay. आगे क्या है, rates are rounded off to 4 decimals in multiples of 0.0025. We'll keep that aside for the timing. We'll not really bother as much of 0.0025. We're just focusing on the concept, not really rounding off and creating more confusion. On 10th of June, bank swaps. अच्छा, ये नहीं भी दिया रहता था, you should be in a position to figure this out on your own. This is given to you, but I'm saying that even if this was not given, I've not even read this. But in most questions, this might not even be given to you. So what will happen on 10th of June? Ideally, please pay attention. Ideally on 10th of June, the banker would be waiting that the customer will come, and hence the banker would have actually, from the interbank market that it would have entered into, so from the interbank market, it would have arranged $2 lakh as per its agreed forward transaction. So banker has $2 lakh and it had plans, and for this it would have paid, let us say 2 lakhs. This is not required to be shown in the exam. I'm just showing for a detailed understanding. At 64.28 per dollar, it would have also paid this 2 lakh into 64.28. That comes to 1 crore 28 lakh 56,000 rupees. 1 crore 28 lakh 56,000. So this is a cash outflow. This is an actual movement of cash. This is not just on paper, an actual movement of cash. The banker would have expected to hand over that 2 lakhs to the customer and in return receive money. But this 2 lakh deal did not happen because the customer gave no instruction. Ideally, I had planned to give this to the importer, but the importer did not show up, and hence I could not give this 2 lakhs to the importer and receive whatever 64.4 from the importer. However, what do I do with this 2 lakhs? I've received this 2 lakhs. What do I do with this? Well, the fact that I'm now stuck with that 2 lakhs, the banker would then, so what is the swap? What does the banker do in the swap? The banker over here will say, well, you know what? I have $2 lakh. I will have to, the importer did not come. What do I do with such a big amount with me? I will sell it in the spot market. So the bank over here, as a part of the swap means opposite movements. So the $2 lakh that it has received in our chart too, this $2 lakh, it will sell in the spot market. So the banker over here, because the customer did not show up, will sell this $2 lakh in the spot market on 10th of June. And if the banker is selling, the banker will approach another banker, and hence the banker is selling. So if our bank is selling the dollars, some other bank, which is the counterparty, is buying the dollars, and hence this transaction will happen at the spot dollar bid rate. I will again repeat, our bank is selling, but we are approaching another banker. So we are like the customer in the interbank market, and hence when we go and approach someone else across the counter, the other party would say that you want to sell dollars. Well, that means I'm buying the dollars, and hence the transaction happens on 10th of June. On 10th of June, the transaction happens at the dollar base currency mein denominator mein dollar hai, so rupees per dollar. So at the dollar bid rate, which is 63.80. So this transaction is going to happen at rupees 63.80 per dollar. So is that also a movement of cash? Yes. Against this is a cash flow. Achha, what is a cash flow? Well, we are going to sell this, and as a result, we are going to receive. How much are we going to receive? Well, we are going to receive immediate cash of $2 lakh into 63.8, which comes to 1 crore 27 lakh 60,000. So this is a cash inflow. Rupees 1 crore 27 lakh 60,000. But is that it? This is one part of the swap. This is one part of the swap, that is sell in the spot market. Why did you need to sell in the spot market? Sell $2 lakh spot. Why did you need to do that? Because I honored the interbank transaction. I cannot go absconding. And at the same time, what do I do with this dollars? Well, I will sell those dollars because the importer has not come. But अभी अपन हाथ पे हाथ धर के बैठ सकते नहीं बैठ सकते. Why? Because Fed says you have to keep this open for the next 15 days, and hence if the customer lands up in the next 15 days, you will have to honor. तो अभी हमारे को क्या पता, कल उठ के हमारे पास डॉलर नहीं हुआ, मार्केट में स्ट्राइक आ गया, क्या पता क्या हो गया, वी डोंट नो, एंड हेंस वी वुड वांट टू कीप आवर सेल्फ secured, and hence the banker will enter into a new forward contract for which period, well yahan pe balance unexpired period nahi hai, we are already at the date of maturity. Typically we should do this for the next 15 days. Abhi 15 days ka shayad forward contract na bhi ho, so generally what the banker will do is the nearest forward contract, and the nearest forward contract might be the contract which expires at the end of June. So the contract that expires at the end of June, this is the spot rate today. Abhi niche aap dekho, end of June, you will enter into contract on 10 June. You will not wait till 20th June. हमें पता भी नहीं 20th June को कोई आएगा या नहीं. But we have to legally keep this open for the next 15 days. And hence if the customer comes and if I am unable to give him the dollars, I will be at default, and hence I will arrange a new forward. Now the customer might come and we will have to give the dollars to the customer. So if we have to give the dollars to the customers, we have to arrange to buy the dollars from somewhere, and hence as a bank I will approach the interbank market in order to buy these dollars, buy $2 lakh so that I can hand it over to the customer. But if I am buying these $2 lakh, the interbank dealer is selling those $2 lakh, and hence the transaction happens at the ask rate. So this would be at 63.95. So over here, as a part of the swap, I will have to also enter into a transaction to forward buy the nearest. So the June forward contract at the rate rupees 63.95 on 10th of June. Acha, does that result in any cash flow? No, there is no cash flow on 10th of June for this. There is no movement of cash, but you have actually would have signed the agreement. And hence the second part of the swap means two opposite things, right? Exchange, जैसे बोलता है एक चीज sell करो एक चीज buy करो. So over here this will, if you don't remember and you can't think through all of this, you just have to remember कि what am I going to do today in the spot market? I've received the dollars, I will sell it, and hence forward में we will have to enter into the opposite position. Here we have logically thought कि क्यों forward में buy करना चाहिए, because the customer might come in the next 15 days and we might have to honor that commitment, and hence we are trying to buy. So over here this is buying $2 lakh in the nearest forward market, which is the June forward, and this is the swap. Are we getting this? So this is the actions that are going to happen. However, what is going through over here is exactly what we have concluded on 10 June. Bank swaps by selling spot. So we have sold that what we received from the interbank and buying 1 month forward. Why did we do that? Well, that is the smallest forward available. We don't have for 15 days. So the nearest, that is the June contract, we buy. What are we supposed to do? We are supposed to calculate the cancellation rate. Remember, the cancellation happens on 20th June over here. Implicit, if not, then 25th ko hota tha, not on 10th of June. Amount payable on $2 lakh. The swap loss due to the swap that has taken, interest on outlay of funds, the new contract rate because of extension, and the total cost. So let us get started. You don't have to prepare any of these charts. In fact, the next problem that you will do, you might not even prepare this. It is just that this was the first problem. In order to explain, we were doing it. So from the theory that we studied, there are, in cancellation, you have to pay 3 charges. First is for the exchange difference. Second is for the swap loss, and third is for interest. Remember, if there is a gain, that gain is not going to be handed over to the customer, but if there's a loss, the loss will have to be paid by the customer. So first of all, what will you have to do? There will be, on cancellation, there will be what you call as exchange difference. This exchange difference is due to the act of cancellation. If there was a cancellation sum, which was the usual simple sums that happen on or before the due date, there is a cancellation. वहाँ पे gain भी हो सकता है, loss भी हो सकता है. Here, if there's a gain, nothing to be done. If there's a loss, then recovered. Exchange difference. Acha, when does the cancellation happen? The cancellation happens on 20th of June. So remember, the actual cancellation is not on 10th of June, it is on 20th of June, and as a result, when we try to find this difference, we will say that by what was the agreed forward, and we are thinking it from the importer's perspective. So from the importer's perspective, from importer's perspective, the original transaction, from importer's perspective, the original transaction, the agreed transaction was a forward buy transaction. So the original transaction was a forward buy for $2 lakh at the rate 64.40 per dollar. So this is like the cost price, right? So this is the buying price and hence the cost price. You will have to cancel this. You know that आपके वजह से गलती हुआ तो you will have to cancel this, and usually the cancellation is on or before the due date, and hence we take the balance unexpired period or the spot rate, but this is cancellation after. तो जब भी आप पहुंचे बैंक पे वो दिन का रेट देखा जाएगा. So you will take the spot rate. Cancellation will be at the spot rate on 20th of June. And if there's any exchange margin, you'll have to adjust that as well. Acha, what is the spot rate on 20th of June? Well, as an importer, if there was a buy contract, it has to be cancelled through a spot sale contract. So this has to be cancelled through a spot sale. Remember, offsetting रहता है, opposite position लेना पड़ता है. So a spot sell on 20th June at the rate. Acha, if as an importer you are going to sell, that means as a banker, someone will buy. So if the importer sells, the banker buys, and hence the transaction will happen at the spot bid rate. So do we have the spot bid rate on 20th of June? The spot bid rate on 20th June, the spot bid rate is 63.68. And ideally, this should be the cancellation rate, which is your selling price, the importer's selling price. He's nullifying the contract. But over here, the question tells you that the exchange margin of 0.1%, exchange margin is applied on the cancellation rate as well as on the extension rate. Remember that. So over here, what is happening is there's a spot sell at the rate rupees 63.68, is it? 63.68, yes. 63.68, and this is your so-called gross selling price. A buy contract, there was a cost price, you had a buy contract, so this is the buying price, and this is a sell contract. So for the importer, this is the selling price. Now there's always this problem that exchange margin you should subtract or add. Remember, this is like a commission agent. A commission agent, if you are buying a flat and you have appointed an agent, तो flat का जो cost होता है उसके ऊपर आपको pay करना पड़ता है. Commission increases your cost. Or if you are selling a flat and appointed an agent, then whatever you are going to receive from that, he will deduct, not add, deduct and give you. So here this 63.68 is like the selling price, and hence what you are going to get is after deducting the exchange margin, not adding. Therefore, the net cancellation rate would be rupees 63.68 per dollar less 0.1%. 0.1%. Ideally, you should round this off, but I'm just solving it as it is, focusing on the concept more than the rounding off. Institute has also not done that. Erroneously, I would say this is rupees 63.6163 per dollar. They've shown the rounding off over here to I think 75, and then while solving further they've ignored that rounding off. But this is like the net selling price. This is like the net selling price. So the importer over here was originally going to buy at 64.4 and sell at 63.61, and hence for the importer there is a loss due to the cancellation, and hence importer has to pay this. So over here this is like the loss on cancellation, which is, for your understanding, payable by the importer, and hence यहाँ पे उसका payment आएगा. If it was receivable, ignore कर देते. Payable by importer to bank, by the importer to bank. Usually we calculate the gains and losses as SP minus CP, so you can do it by any other way, but I prefer the SP minus CP route. So this is, let us say, equals selling price, which is 63.6163 per dollar. This is like the selling price less the cost price, that is 64.4000 per dollar. This is like the cost price. This is on per dollar into $2 lakh, and hence you will get a loss. you will get 63.6163 minus 64.4 negative, so that's a loss, into $2 lakh, which is 156,740. negative के बदले हम यहाँ पे loss लिख देते हैं 740. This is like a loss, and as per FedI rules is a loss payable. This is a loss to the importer, and hence the importer will have to compensate loss payable by importer. But is that it? Does the matter end? No. Because of FedI rules, the banker had to also enter into a swap. So this is part A. This deals with two parts of the question. That is the cancellation rate, which is I think 63.6163 rounded off if required, and amount payable, which is rupees 156,740. अच्छा, what is the swap loss? Swap loss find करने के लिए we need to figure out what is the swap transaction. So over here, the swap transaction you could have inferred, as per what we have said, is you will receive the money from the interbank market and you will have to sell it. So there will be sell spot and buy forward. So this is an independent transaction, not subjected to exchange margin. So exchange margin is levied, remember, only on the cancellation rate and extension rate. So over here, if you want to find the swap loss, what does a banker have to do due to the swap? So the banker will have to sell spot. The dollar that it has received, it will have to sell in the spot market without any exchange margin. So $2 lakh. If ये कभी अपन बेच रहे, this is sold on 10th of June. Remember, $2 lakh sold on 10th of June. If banker sells this $2 lakh, the interbank banker is buying that, and hence that will be the spot bid rate on 10th of June. So that is 63.8. So this is into rupees 63.8 per dollar, and you will enter into a buy June forward, the nearest forward, buy June forward. This is $2 lakh into June में क्या है? You are going to buy. Well, if you are going to buy the dollars, the counterparty is going to sell the dollars, and this is at the nearest. So it is 63.95. So this is into rupees 63.95. Remember, for the banker, if you are selling, this is again the same thing. This is like the SP, and if you are buying, this is the CP. So if you multiply these two, always remember, you follow the SP and CP rule. So this is 2 lakhs into 63.8. So this is rupees 1,27,60,000. This is like your selling proceeds that you're receiving in rupees. And 2 lakhs के लिए जो हमने forward enter किया 63.95, no exchange margin over here. So this is rupees 1,27,90,000. This is like the CP, and hence as the CP is greater than the SP, there is a swap loss due to this swapping, where I'm selling in the spot market and receiving 1,27,60,000 and entering into a forward whereby I'm going to pay 1,27,90,000 because the customer did not show up. I incur a swap loss of 30,000, which is called as B. This is also something that the customer has to pay. Are we done with the problem, sir? Unfortunately, not yet. So this comes to 30,000. This is swap loss, and there is interest on the outlay of funds, if any. Acha, outlay of funds यानी क्या रहता है? There has to be a cash movement. On 10th of June, what is happening? On 10th of June, you are actually honoring the interbank transaction for which you are receiving $2 lakh on one side, and in the spot market selling those $2 lakh. So $2 lakh अंदर आया, $2 lakh बाहर चले गया. There was no cash movement. However, for receiving those $2 lakh, you were paying at the rate 64.28 a cash outflow in rupees, and on selling those $2 lakh, you received 63.80 a cash inflow in rupees. Dollar तो nullify हो गया, but rupees में you might have paid slightly more and received slightly less on 10th of June for a transaction that is ultimately settling on 20th of June, and hence for those 10 days, interest at the rate of 12% will be levied. So over here, if I were to calculate interest, there will be, for the bank, there will be a cash outflow due to the original interbank transaction. Acha, original interbank transaction was $2 lakh, which we had signed on a piece of paper on 10th of April, but it has to be honored. It has to be honored on 10th of June, and hence there will be a cash outflow to the tune of $2 lakh into 64.28. So that comes to rupees 1,28,56,000. This is like a cash outflow. Similarly, ये जो $2 lakh हमारे पास आया, we would have sold this $2 lakh in the spot market. So there will be a cash inflow on selling those $2 lakh. So this is on selling $2 lakh immediately in the spot market because customer did not come. And this $2 lakh when you sold in the spot market, you would have received rupees. So $2 lakh inflow outflow gets cancelled, but rupees में देखते हैं क्या हो रहा है. This is 63.8, and hence what you are getting is a slightly lower amount. So this is $2 lakh into 63.8 comes to rupees 1,27,60,000. This is a cash inflow, and as a result, there is a net cash outflow of let's say rupees 1,28,56,000 minus rupees 1,27,60,000. उसके लिए exchange differences, swap cost वगैरह consider कर दिया है, but this is going to settle after let us say 10 days. एंड बैंकर को यूजुअली ये सब करने का जरूरत ही नहीं था, ये तो क्या 10 दिन के बाद होएगा, बिकॉज कॉन्ट्रैक्ट 10 डेज के बाद सेटल हो रहा है. सो दैट इज 12% इनटू लेट अस से 10 upon 360, which is taken by the institute. You can very well take 365 as well. So this is let us say 128.56. Your cash outflow is higher by 96,000. So this is 96,000 rupees into 12% into 10 by 360. We are doing this as per the FEDI rules 8. It seems to be a little baffling if you are unable to grasp it. अपन ने जो चार्ट बना है उसमें जो रूल याद रखा वो आप सीधा कर लो, एग्जाम में मार्क्स लेको, आगे निकलो. Otherwise, we have tried to discuss the logic and rationale as well. So this comes to rupees 320 as well. So interest is 320. Acha, what is the total cost? Total cost is A plus B plus C. So interest is C. So in 0.5, your total cost on cancellation will be A plus B plus C. That is rupees 1,56,740. That's a cost. Plus rupees 30,000. Again a cost. There is no gain over here. Plus rupees 320. Again a cost. And hence this is 156,740 plus 30,000 plus 320. So this is 1,87,060. 187,060. Then what is asked over here? Well, the new contract rate. You are demanding an extension and you are originally an importer, and an importer needs to buy the dollars. So if the importer buys dollars, and when are you demanding that extension? On 20th of June. So for how long are you demanding that extension? You want this contract, the importer requests for an extension up to 10th of August, which means you're wanting it to go up to August. So on 20th of June, again on 20th of June, you will try to buy the dollars as an importer for the next 2 months roughly. So that is around August. And if you are buying, the banker is selling, and hence the transaction happens at the ask rate. So this is the August transaction, and the August transaction on 20th of June at the ask rate. So ideally it should be 64.25. However, this is a cost. The customer will have to pay this, and यहाँ पे exchange margin आपको लगता है. So your extension rate, the new rate for the importer, which is a forward buy that you are doing on 20th of June. So this is for the August contract, which is available as such. Had there been no such transaction, this would have been available in August at the rate rupees 64.25. Now the question arises that will you have to adjust the exchange margin? The answer is yes. Will you have to subtract or add? Well, it has to be added, because now this is like a forward buy, and hence this is like the cost rate. And if the banker is charging a commission, it is going to increase the cost, and hence you will add this. So 64.25 plus 0.1%. So this is rupees 64.31425 or 43 per dollar. Ideally, you should round this off as well. So this is 64.31425. We will just see if this kind of makes sense. 0.1 barabar hai 63.63, 1,56,740, 30,000 being the swap loss, 320 with 33 assuming 360 days, 64.3143, and obviously you'll round it off over here, and last में 187,060, and that should be it. So that takes care, and we'll see if we can just practice one more problem over here. Okay, so we'll go to the next question, the last one, which is I think question 59 of the old course PM, and if you're referring our textbooks, it is question 62 of our textbook. So let's go through the PM if you have that handy, or you can go to question 62 if we have already done that. So this is from the practice manual, question number 59. Let's go through this. And hopefully you should be able to solve this on your own. There are a bit of variety over here because there's cancellation, extension, even execution of the contract. So let us say on 10th of July, an importer entered into a forward contract with a bank for $50,000 due on 10th of September. So from 10th of July to September, so that's August and September, so that's 2 months, at an exchange rate of 66.84. The bank covered its position in the interbank market at 66.68. So this is the agreed forward rate, and this is the interbank forward rate. How would the bank react if the customer requests on 20th September, that is plus 10 days after the original date of maturity? So 20th September is the actual date of cancellation, whereas 10th September is the original date of maturity. We are doing this in rough. If the customer on 20th wants to cancel or even execute, which means actually enter into the contract or extend the contract with the due date to fall on 10th of November. So that is plus another, let's say roughly 2 months from September, another 2 months. The exchange rates in the interbank markets are given to you. So you have the spot rate, then the September rate, October and November rate, exchange margin of 0.1% on both buying and selling, interest on outlay at 12%. You are required to show the calculations for cancellation, execution and extension. So it's largely similar to the question that we have done, just that we have more practice and we can do it directly over here. So when we do the question, we can directly try to find the exchange gain or exchange loss. So over here for question 59 of the old course practice manual, we can directly start with the first point. We don't need to prepare those charts like we did in illustration 9 of the new course study material. So the exchange difference, on what will you calculate the exchange difference? Well, we will say that this is a gain or loss on cancellation. And when is the cancellation happening? Well, on 20th of September. Well, what was the original contract? Well, being an importer, the contract for the importer was a forward buy contract for $50,000, which you would have entered at the rate of rupees 66.84 per dollar. So this is rupees 66.84 per dollar. If you have to cancel this, first of all, the cancellation will happen on 20th of September instead of 10th of September, which is within the Rule 8 limit. This will be through a spot sell of $50,000 at the rate. So if the importer or the customer sells, the banker buys, and hence the transaction happens at the dollar bid rate on 20th September, that is 65.96. So ideally this should be rupees 65.96 per dollar. Well, your original transaction, this would be your buy rate. So this is like your cost price CP, and this is your gross selling price. However, the net selling price, the net cancellation rate after considering the exchange rate margin, should be rupees 65.96 to the dollar. What do we do? Should we add, subtract, pause, think and figure out? Well, you should subtract. Why? This is selling price and commission should reduce your selling price. So this is less 0.1% and hence this is 65.96 minus 0.1% will be 65.89, 65.8940 per dollar. This is your net cancellation rate. And if you were to find for the customer, that is for the importer or the customer, what is the net selling price, that is 65. So you are going to sell the dollars at 65 and buy it at 66. Well, there is a loss. If there was a gain, you would have ignored it. So this is rupees 65.8940 per dollar. Alternative ways in which you can do everything should give you the same answer. Less rupees 66.84 to the dollar. This is like your cost price on $50,000. And we multiply this. So this is 65.894 minus 66.84 into $50,000. There is a loss, so it comes to be negative. Should be 47,300. This is loss payable by the customer, by the importer. Acha, is that it? No. There is going to be a swap, and as you can see over here, the swap has not been given to you in the question, like you were given in illustration number 9. But it is fairly easy. What are you going to do? You are an importer and you have taken a forward buy contract from the bank, which means the bank would have in turn in the interbank market entered into another forward buy contract, which the bank will honor. And as a result, the bank would receive $50,000 and as a part of swap, it will sell $50,000 spot. At the rate, you will find this. And अगर आपको याद रहता है conceptually तो ठीक है. Otherwise, you can always say forward के लिए opposite करना होता है conceptually, because the bank has to keep it open for the next 15 days and the customer might come and buy and the banker might need to pay. So the banker would have to enter into a buy 50,000 forward contract, forward September over here, I think, contract at the rate. So you'll try to find the cost price as well as the selling price. So over here this is happening on 10th of September. This swap, remember, will happen on 10th of September. So on 10th September, spot sell, this is $50,000 into, there is no exchange margin over here. If the bank sells, the counterparty, that the interbank market will buy, and hence the transaction will happen at the bid rate. It will happen at the bid rate, that is 66.15. At the same time, the bank will have to buy, and hence the counterparty will sell in the forward market, and hence this will be 66.32. So this will be 66.15 into rupees 66.15 to the dollar, and a forward buy. This is $50,000 into rupees 66.32 per dollar. So let me just cross verify 66.15 and 32, that is correct. So this is, if you multiply, this will be $50,000 into 66.15. This is rupees 33,07,500. This is sell, so equivalent to your selling price, and 50,000 into 66.32. So that is rupees 33,16. This is like you're buying, and hence the cost price. So if you have to find a swap loss payable by the importer, swap loss payable by the importer, well, you will have to find the difference between sale and purchase. So this is rupees 33,07,500 less rupees 33,16,000, and hence you are paying more. How much more? Minus 33,07,500. So this is, I think, 8,500. This is your loss, which is payable by the customer. So this is the second part. We'll just cross verify. If you go to C, We have rounded off. This is around 47,250, which is same as what we have calculated in the first part, part A. 47,300. There's a slight difference because there is a rounding off that is happening here, and so that is to a nearest number, and there is 8,500, which is the same. So is there anything else? Yes, there is interest. अच्छा, interest किसके ऊपर अपन calculate करेंगे? Well, on only those cash flows. What are the cash flows? Interest, remember, will only be on cash flows. Cash flows will be, you will receive $50,000 and hence pay 66 point whatever is agreed in the interbank market, 66.68 you will pay, and you will receive in the spot market 66.15. So these are the only cash flows. So interest will be on cash flow. So there will be a cash outflow. This is on the interbank market. ये जो अपन ने purchase किया, we would have purchased $50,000 at the agreed rate, that is 66.68 per dollar, and there will be a cash inflow because you will sell these $50,000 and in return of that receive rupees 66.15 if I am not wrong. So if you multiply, you can always net this directly, but if you multiply 50,000 into 66.68, so that is rupees 33,34,000, and this is your cash outflow CO, and 50,000 into 66.15, this is rupees 33,07,500. So this is a cash inflow, and hence there is a net cash outflow, a net cash outflow of 26,500, which is outstanding, let us say, for 10 days, that is from 10th of September to 20th of September. So I'm just doing this in rough. So this is 10 days upon 360. You can always take 365, and hence there will be interest on outlay. So that is 26,500 into 12% into 10 divided by 360. So that should be around 88 odd rupees. Let me just check. So this should be around 87 or 88 rupees. That is correct. So 26,500 for 10 days. So that is around 88 rupees roughly. And this will be point C. So your total cancellation charges, what will happen if you decide to cancel the contract, will be A plus B plus C. So that is 47,300. We have not done the rounding off over here. Plus swap of 8,500, again a loss, plus 88, again an interest payable. So if you total this, that's 47,300 plus 8,500 plus 88, and that is rupees 55,888. So this will be your total amount on cancellation. That is almost the same. The second part of the question tells you that what if you were to execute the contract? Execute means the customer wants the dollars. If the customer wants the dollars, cancellation charges he will have to pay. उसमें तो कोई choice है ही नहीं, 55,888. But if he wants the contract on execute on 20th of September, he will have to buy at the spot rate because the existing contract has been cancelled. And he will have to take at the spot rate. Spot rate on 20th of June will be, the importer will buy and hence the banker will sell. The banker will sell at 65.99. However, 65.99 is the gross buying rate. Because I'm doing this as a part of the contract, there will be an exchange margin of 0.1% that you will add. So this is 65.99 plus 0.1%, and hence this is going to be rupees 66.05 0.06 per dollar. Let us say if you multiply this by 50,000, so 66.056 into $50,000, and you will get roughly 33,02,800. Fair. So this takes care of the second part over here. So this is, if you go to see this is 55,000 and the rate is 66.055. or 5.6, and that is almost the same number. And then the last part, if there is an extension, as an importer, you'll still have to pay the cancellation charges. You'll still have to pay the cancellation charges of rupees 55,888. However, there will be a new contract that will be entered for the November. ये अपन ने कभी enter करना है 20th of September you will enter, but this is a contract that is going to expire in November. Which of the two will you take? Well, as an importer, you would want to buy the dollars, and as a result, the banker will sell the dollars. The banker will sell the dollars at the ask rate. So this is 66.49. However, on 66.49, you will have to apply the exchange margin. Again, this is like a buying rate, so you will add, and hence this is 66.49 plus 0.1%. This is rupees 66.5565 per dollar, and you will multiply it by $50,000, which you will have to pay on 10th of November if you go to see. So let us try to cross verify for the this is fine. The third one is 66.5575. 66.5575, is that the same as a number? Yes. So this is around 65. Actually was 65 ही है, यहाँ पे printing mistake है institute के side पे. It is actually 65. If you see over here, they've actually written then over here 75 for the rounding of. I hope that's clear. Okay, so that kind of takes care of the part on automatic cancellation, a fairly important part. So thank you very much for your time. I hope you have understood this concept, and I'll see you soon. Bye bye. Take care. Goodbye. Have a good time.